If these 5 metrics aren't tracked, investors already know. So there's a pattern that shows up constantly in investor meetings. Strong deck. Maybe a compelling story, a founder who clearly believes in what they're building, and then the numbers come up and everything falls apart. It's not because the business is bad, it's because the founder doesn't actually know what the metrics mean. They know the surface numbers, but they don't know what's underneath them. That's usually what loses a deal and credibility with investors. Here's a breakdown of the 5 metrics investors actually care about, why most early stage founders are tracking the wrong things entirely, and what to do when the numbers aren't where they need to be yet. So before getting to the 5, there's a concept worth going through because it's where most pitch decks go sideways. Vanity metrics are numbers that appear impressive but don't actually reflect the health of a business. So total app downloads, website visitors, registered users, social media followers. These numbers feel good on a slide and maybe look good, but sophisticated investors are going to see through them immediately. A vanity metric tells you what happened. An actionable metric tells you whether it's sustainable and why. For example, 10,000 app downloads is a vanity metric. 40% of those users still active at day 30. Now that's actionable retention. That's something an investor can actually underwrite. So the question worth asking before any number makes it into the deck is, does this tell the story of a healthy, growing business, or does it just look good? Investors are asking the same exact question in real time, and they've seen enough decks to know the difference quickly. So metric 1 is revenue growth rate, not total revenue, it's the growth rate. A company doing 10,000 a month growing at 20% month over month is more interesting investment than a company doing $50,000 a month growing at 2%. Investors aren't buying the present, they're buying the trajectory. Growth rate is what tells them where the company is actually going. So the benchmark worth knowing is top tier seed stage startups are typically growing 15 to 20% month over month. If that's the situation, it should be said clearly and early. If it's not, that's something to address, and there's a way to do that without killing the conversation completely. So metric 2 is kind of in 2 parts, your customer acquisition cost and lifetime value, LTV. CAC and lifetime value bring together one fundamental question. So does the model work? CAC is what it costs to bring in one customer. LTV is what that customer generates over the full length of the relationship. The ratio investors want to see is at least 3 to 1. $3 back for every dollar spent on acquisition. Now, when LTV is lower than the cost of customer acquisition, the business is losing money in every customer it adds. So that's not a growth problem, that's a structural problem. And investors know you're not perfectly profitable yet and you're figuring things out. So they'll want to know what you're testing, with what budget, on what platforms, and in what ways. These numbers need to be known before walking an investor meeting, and they don't want your accountant telling it for you. Metric number 3 is churn rate. So churn is the percentage of customers who leave in a given period. It's also the metric founders often try to bury. And that's a mistake because investors are going to look for it specifically. If it's being avoided, that's going to become a signal within itself, one about self-awareness and not just performance. For example, in SaaS, monthly churn above 5% is a serious concern. Below 2% is strong, but the trend matters as much as the number itself. Are recent cohorts churning less than early ones? That shows learning is happening, that the product is improving, that the team responds to feedback, and investors are going to fund that kind of founder. And metric 4 is 2 parts, burn rate and runway. Burn rate is monthly cash spent, and runway is how many months remain before that cash runs out, which is why they go together. Investors need these numbers for a specific reason to understand how much time exists for them to make a decision and for the company to hit their next meaningful milestone. The standard expectation is that the round being raised should produce typically around 12 to 18 or max of 24 months of runway. And if the math doesn't support that, the answer needs to be ready before it's asked. So whether that means raising more, cutting burn, or both, showing up without a clear answer to this is going to signal the financial picture hasn't even been thought through. Now, metric number 5 is the NPS or customer engagement score. This one surprises founders, but this is why it matters. The Net Promoter Score measures how likely customers are to recommend the product. Engagement metrics measure how deeply they're actually using it. So together, these answer the question investors are always quietly asking. Is there a real product market fit here, or is it a paid acquisition masking a product that people don't actually love? High NPS means customers are doing the selling for the business. Strong engagement means that the product is sticky, and both of those signals point towards a business with a real solid output, and the investor can feel that difference between the two scenarios, even when the revenue numbers look similar. Here's how to present them. Knowing the numbers is half of it, but presenting them well is the other half. So benchmarks do the work for the investor rather than making them figure out whether a number is good. So telling them the churn is 1.8% compared to an industry average of 3% is proper communication. Now, you can easily research standards for your industry as most of this kind of data is public. Now, bad months also deserve a direct explanation. If there's a dip in growth, a churn spike, or a rougher quarter, the worst move is hoping it will go unnoticed. Naming what happened, explaining the cause, and showing what changed demonstrates exactly the kind of self-awareness and operational control investors are looking for in someone they're about to hand a significant amount of money to. Now, what to do when the numbers aren't there yet? This comes up constantly, and the honest answer is don't raise before the metrics support it. Walking into investor meeting with weak numbers or no clear narrative for why they're improving is one of the fastest ways to burn a relationship that will matter later. So the better move is to identify the weakest metric and go after it directly. If churn is too high, talk to churn customers this week. If growth is flat, run an acquisition experiment. If LTV is too low, find one retention lever or upsell opportunity and pull it. And in the meantime, use that period to build investor relationships, even without an active raise. And share monthly progress updates. Let the metrics improve over time and speak for themselves. Ask what KPIs they want to see that would make it impossible to say no. And by the time the raise actually launches, they're going to see that trajectory, and that trajectory becomes the pitch. So this is really what it all comes down to. Investors aren't impressed by big numbers. They're impressed by the right numbers presented with context, trends, and benchmarks. This is what shows the founder understands their business at a level most people pitching don't. So growth rate, cost of customer acquisition, LTV, churn, burn, and runway, and engagement. Founder who walks into a room speaking frequently about those with the trend lines, benchmarks, and honest context is what is going to make the difference between a check or not at the end of the day. And remember, not all of us have to be good at numbers to be able to present them. It's a skill you can work through, and there's plenty of data and tools that are out there. If you want me to share some financial templates and resources, drop a comment below and be sure to subscribe because I've got weekly videos coming out to help you become a more fundable founder.